Hello, I'm Chris Pedersen and this is Stock Watch on Wednesday, the 28th of August, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. Here are a few of my market observations. The ASX 200 is now over 8,000. That is amazing. One reason why the broad-based index, the ASX 200, is weak in September is due to all the companies going ex-dividend. Just because they go ex-dividend and the index drops doesn't mean the index is really losing value. Many investors are buying long-dated bonds right now because the profit from the decline in future interest rates will be greater than what they expect in price appreciation for equities. This chart is the S&P 500 and it shows volatility from 2000 to 2024. This is one of the most important charts you will ever see in your investment life. I'll tell you what it says. This goes back to the GFC, the crash from COVID. All the upward spikes are various times when the market has plummeted. But what we see is that volatility will spike up, but it never keeps going up. And volatility will go down, but it never keeps going down. This is significant because when you're buying individual shares, they can go down and they can keep going down, down, down and get to zero. Or if you take something like NVIDIA, they can go up, up, and continue going up, which means that if you get your position wrong with an individual share, you can lose a fortune. However, when it comes to volatility, it will spike and always come down. When volatility is low, there'll always be periods when it goes back up. Thus, trading volatility can be one of the most profitable, easy trades you can do. This shows that not that often volatility goes over 50%. When it does, you can create a trade using derivatives. It's not that hard. Talk to your advisor, where you take advantage of the increased volatility, and when it drops, you will make a profit. When volatility is really low, you can put on trades where you're buying volatility. When it spikes up, you can have massive profits. Both trades are not that hard to construct. If you want to learn more, send me an email. This is a chart that I found pretty interesting. It shows job listings for either remote or hybrid jobs. What you see is it's declining. People are coming back to the office, either by choice or because their employer demands it. Recession probability is rising. I just threw this in. The reality is we don't necessarily know if a recession's coming. However, yes, it is rising because we know that at some stage there will be a recession. It's sort of like in sales. Every no means you're closer to yes. Well, when it comes to predicting recession, well, every day we go without a recession means we're closer to a recession. I mean, it's not really something you can trade off of, but it's kind of interesting. Three companies I wanted to cover today. First is Bank of Queensland, BOQ. It's trading at $6.22. This company, looking at this 5-year chart, has had a terrible history. Recently, it's stabilized. It's starting to trend up a little bit, but has it truly recovered? Let's take a look. These estimates are from Macquarie. First off, Bank of Queensland has a market cap of $4 billion. So as a bank goes, it's not that big. Price target, according to Macquarie, is only $5. Well, it's trading at $6.22, so Macquarie is not that bullish on it, obviously. Revenue growth from 2024 to 2026, they estimate is only 5% per annum. Well, at least it's growing revenue. Some of the banks, their revenue is flat. Earnings per share growth, though, is only 1.8% per annum. And the dividend growth is minimal, basically zero. The PE on the 2026 earnings estimate of 47.1 cents is 13.2. Well, for a regional small cap, I think that's pretty high for a PE. It should be a little lower because the reality is financial companies do have more risk than some industrial companies or companies like Woolies. They're defensive. The yield on the 2026 dividend estimate of 34 cents is 5.5%. Cost to income ratio is 66%. Now, this is important because what it tells me is, one, that they're not really managing their costs all that well, but two, they can get that down. There's upside to the company. Payout ratio is 66%, which is healthy because it means 33% of their profits they retain for growth. It's a regional bank in Queensland, as most of you know. It's smaller with less economies of scale. However, before I rate it a buy, I need to see that this recovery is sustainable. Accordingly, I rate it just neutral now. I don't rate it a sell like Macquarie. Inghams Group Limited is the second company. The code is ING on the ASX and it's trading $3.10. Looking at this 5-year chart, what you see is the stock has dropped a lot just the past few days. Let's take a look at the numbers. The estimates are provided by Macquarie, and the market cap for Inghams right now is $1.1 billion. It has a 12-month price target of $3.50. The revenue growth for each of the next 2 years is 0%. The earnings per share growth is a little bit better at 2.7%, and the dividend growth is 0.8%. So based on these numbers, the company's not really growing. So I dug into it a little deeper, and what I found is the shareholder equity growth is growing at 16% per annum. That's excellent. This is because they're paying down their debt. They're pretty aggressive. The debt to equity ratio is a little bit high for them. Well, actually quite a bit high. The PE on the 2026 earnings estimate of 31 cents is only 10 times. The yield on the 2026 dividend estimate of 20.3 cents is 6.5%. Now, a little word on higher yielding dividend stocks. There could be two reasons. One, it truly is an income stock and has no capital growth potential. But another is that the market is viewing the stock negatively, and they haven't cut dividends yet, but the price has dropped in anticipation of it, which gives you a short-term high dividend that is not a true picture going forward. In Inghams Group's case, I view that the dividend is fairly secure. Accordingly, this dividend yield is pretty much at 6% or higher. Another aspect of the company is it has a return on equity of 46% and a payout ratio of 70%. So overall, Inghams looks like a pretty good company. It just has some poor growth right now, but there's reasons behind it. And the major reason is that Woolies has reduced the volume they buy from Inghams. Now, Inghams is the largest poultry provider in Australia. It's a very strong company. It's a very tough company to do business with, similar to Woolies. I can't imagine Inghams won't be able to find other markets to sell their chicken if Woolies doesn't come back to the negotiating table. I view it still solid. I rate it a buy, but only a half weight. The third company is Qube Holdings Limited. The code is QUB, and it's trading at $3.84. What you see here on the 5-year chart is it's been performing extremely well the past year. Now, looking at JP Morgan estimates, we get a pretty good story here. First off, it has a market cap of $7 billion, so it's decent size. 12-month price target by JP Morgan is $4.40. The revenue growth they have from 2024 to 2027 is 5.4% per annum. It's not great, but it's okay. The earnings growth in this period is 5.2% per annum, and the dividend growth is 5.5% per annum. This is not a stellar growth company, but it's a solid company. The PE on the 2026 earnings estimate of 17 cents is 22.5 times. That's a touch on the high side. The yield on the 2026 dividend estimate of 10.8 cents is only 2.8%. But let's take a look at some of these numbers. Free cash flow is around 8%, and the payout ratio is 50%. Qube provides logistics solutions across the export-import supply chain. You've all heard of Patrick's? Well, Qube owns Patrick's. They have a near monopoly, well, a quasi-monopoly at the ports. This is what makes them attractive. They're paying down debt too. They don't have much competition. I rate it a buy. I wouldn't say that it's going to be like one of these tech stocks, but it is a solid company to put in your portfolio and not worry about. As always, if you want to learn more about anything I covered, send an email request at stockwatch@fnn.com.au and direct your questions to me, Chris Pedersen. Have a great week, and I hope it's profitable. Thank you.